Many companies go global by forming new foreign companies or by buying existing businesses, and thus they form groups. Group accounting and consolidation are both very popular topics in the accounting exams, and yes, they are very important too, because we need to see the overall results of the group, not the individual companies, don't we? Well, this is not an easy topic, and there are about 6 IFRS standards covering groups. Well, I'll cover full consolidation in my IFRS kit package, but in this video, I'd like to explain the basic terms and give you the orientation or the roadmap to navigate you in IFRS standards related to group accounts. I'm Sylvia of IFRS Box, and if you'd like to learn IFRS fast, stress-free, and like a pro, then you're welcome to check my IFRSbox.com together with my courses, IFRS quizzes, and many more. Before we start to dive in this complex topic, let me first tell you what IFRSs deal with the consolidation and group accounts. In fact, there are 6 standards dealing with investments or consolidation in total. The first one, IAS 27, separate financial statements. Well, this standard prescribes how the investor or a parent company or a holding company shall present its investments in the individual accounts. So if you have some shares in subsidiaries or other investments, you still need to present your own single financial statements, and this standard tells you how you should show your investments in your separate financial statements. So here you're not dealing with consolidation or any adding up the numbers. You simply show your investment in one line when you present separate financial statements. The second one, IAS 28, investments in associates. Well, we'll define associates a bit later, but quickly. Associate is an investment over which you don't have a control but significant influence, and basically that's when you own somewhere between 20 and 50% of its shares. IAS 28 prescribes how to account for associates and defines and describes an equity method of accounting. The third standard, IFRS 3 business combinations, and this one is really important because it defines what the business combination is and how we shall identify one. And then it sets the recognition and measurement principles of how the acquirer or investor shall treat the goodwill, non-controlling interest in identifiable assets and liabilities acquired in the business combination. So IFRS 3 does not describe the consolidation procedures, but it does describe and define the basics for the consolidation like goodwill, non-controlling interest, and other things. IFRS 10 consolidated financial statements is the standard that is directly related to IFRS 3 because it defines the control, what it is, when the acquirer exercises the control over its acquiree or investment, and then it requires a parent or investor to present consolidated financial statements. It also establishes the consolidation procedures that investor must follow when preparing consolidated financial statements, and among other things, IFRS 10 also sets the exception investment entities that don't need to bother with consolidated financial statements. Then we have IFRS 11, joint arrangements, and this standard deals with the activities jointly executed by parties. There are 2 types of them, joint ventures and joint operations, and IFRS 11 defines them and prescribes the accounting treatment for both of them. Finally, there's the standard IFRS 12, disclosure of interests in other entities. And as its title says, it simply prescribes all necessary information you need to disclose about subsidiaries, associates, joint arrangements, and other entities too. Now, as we are familiar with the IFRSs that arrange all these consol issues, let me bring some light into different types of investments and set their basic definitions. First, we have an investor who acquires some shares, and this is called parent or a holding company. IFRS 10 defines parent as an entity that controls one or more subsidiaries. Note the word control. If a parent controls some entity, then the accounting treatment is totally different from the situation without control. So imagine this parent purchases more than 50% share capital of some other company and is able to control it. Then the investment is called subsidiary, and IFRS 10 defines a subsidiary as an entity that is controlled by another entity. Again, note the word controlled. So when we put that all together, we have a group which is defined as a parent and all its subsidiaries. So technically speaking, group involves only subsidiaries controlled by the parent and not associates or other investments. Now, an investor can purchase less than 50% share. For example, when it acquires more than 20% share and is able to exercise significant influence in the investment, then that investment is an associate, not subsidiary, associate. IAS 28 defines associate as an entity over which an investor has significant influence and which is neither subsidiary nor an interest in a joint venture. Also, there can be another way of investing and doing business together, which is having a joint control with some other entity over some business or assets and liabilities. This is called joint arrangement, and standard IFRS 11 defines it as arrangement of which two or more parties have joint control, and that's all in IFRS 11. Now, let's sum up the differences between individual types of investments here so that you can make a clear distinction and you know what we are talking about. So as we have defined, we'll talk about subsidiaries, associates, and joint arrangements that can be both joint ventures and joint operations. The basic criteria that makes the difference between these types is the amount of power that investor exercises in the investment. When we talk about subsidiary, there is a control, so the investor has the ability to exercise control over the subsidiary. The indicator that there is a control is a share of the investor or a parent on the equity of a subsidiary of more than 50%. Well, but that's just the indicator, because there are some entities without any share and still they meet the definition of a subsidiary, for example, some special purpose entities. So when there's a control, a parent company must apply an acquisition method of accounting when the subsidiary is purchased and full consolidation method for the preparation of the financial statements. Consolidated. Opposed to that, when we talk about the associate, then the investor does not have the ability to control it, only a significant influence. It is the power to participate, but not to control. An indicator of existence of significant influence is that investor holds 20% or more of the voting power over the investee. Well, if it has less, then there's probably no significant influence. In this situation, investor applies equity method for accounting for an associate. Then there are joint arrangements, and these are a bit different because there's a joint control of two or more parties over some business or operation. Because of the control is joint, it has no sense to specify the amount of a share because it's equal. It can be 50 when there are two parties or 33% when there are three parties, or you can continue like that. Method of accounting for joint arrangement depends on the type of joint arrangement because there could be joint ventures. In that case, you'll apply equity method, or joint operations, and here investor accounts for its share on assets, liabilities, revenues, and expenses of the joint operation. Then there are other investments that don't fall into any above category, and these are simply financial instruments accounted for in line with IAS 39 or IFRS 9, whatever you opt to apply. And you can see all the summaries and materials about these two standards in my website or in this YouTube channel. So this was the short introduction to group accounts, and I'll be adding the summaries of individual related standards a bit later. If you're interested in more detailed explanation of the group accounting, please check out my IFRS kit or subscribe for free weekly newsletter at ifrsbox.com. Bye bye, and thank you for watching.